Good morning, my REITs friends and investors. Today we're going to take a comical look on the wealth paradox in REITs. Now, it all started with this comical article that came out, but nonetheless interesting from Business Times today. Yes, it stated there, worse could be over for S-Reits, even as analysts slash the target prices. Well, what's so interesting about it, and what is it about the wealth paradox in REITs? Now, first and foremost, ladies and gentlemen, it comes as a surprise that essentially, analysts will follow as well as fund managers follow the REITs closely, rigorously, to get in touch with the REITs management. How come they only slash the prices after the share prices of these REITs have dropped and not before? Think about it. How much wealth has been destroyed before they even slash the prices? Well, let's look at the report in detail. It says that Manulife saw the biggest cut in target price to 48 cents. This came from DBS. So it's down 31%, the slash in the prices. Now, RHP cut its target price by 18% to 64 cents, and CGS CIMB trimmed its target price by 12% to 69 cents. Well, ladies and gentlemen, shouldn't this have come before Manulife price plunge, as we have forecast in our previous video on Manulife, where in my book, Making a Millions in REITs, which I've written 3.5 years ago, I already predicted the imminent fall in the prices of Manulife before it even happened, and warned in my continuous YouTube videos in the course of the last 2 years why Manulife should not be a core holding in your portfolio, why you should avoid Manulife REIT in your portfolio, why having REITs like Manulife will cause a mental impact on an individual investor's psyche, mental effect physiologically as well as psychologically in the course of the last 3.5 years. So let's look deeper into this very interesting article on Business Times. Now, this next chart shows you, the price drops. Okay, the targeted price change. That means the price slash by DBS alone on the various REITs. That range from 31% on Manulife down to as low as 21% on ECO REIT. You see, nothing wrong with that, ladies and gentlemen. But the key thing that one should be asking is that why was this forecast not actually or forewarned earlier, right? Why tell us or why slash the prices only after the prices have dropped, not before, which was something that we have done all these years. I know, granted, that it's quite difficult to be able to foresee, forewarn, and therefore be able to forewarn, as because you may or may not have the foresight, right, to be able to do so. So in this week's video, we are going to establish and share with you how I have been able to develop this ability that to forewarn and the foresight to be able to see certain things on REITs, and some of the habits that we have cultivated, and some of the daily exercises that we do, right? So there are actually daily exercises that you can sharpen your mental mindset so that you would be able to have the ability to have the foresight as well as the ability to be able to think through certain things before the REIT event essentially happens. So stay with us and subscribe to our video, as we develop and share with you the skills that are needed to be able to develop the foresight and the mental ability to be able to foretell things before they happen in real estate investment trusts. So Gabriel, this tell us this particular exercise, how does it actually help you to elevate the ability to be able to develop foresight and mental strength and ability to encapsulate what's going to happen to real estate investment trusts before it happened, not after the event, not after the share price have collapsed, and that's why you go on to then slash the target prices. Yes, ladies and gentlemen, this is an exercise that we normally do. So, like in our GCP Global Investment classes for real estate investment trusts, which we have been teaching for the last 33 years. And going into next year, we're looking for our 34th year, right? So what we try to do is, as the exercise shows, we try to raise above the bar, we try to look left and we look right for you to unravel essentially the key things that real estate investment trusts are able to dish out. So, for example, as you know, there are 39 real estate investment trusts listed on the SGX currently. Now, each half year, each quarterly, they actually give out business updates to their half year or full year results, for which they range between 30 over pages to about 60, 70 pages, for the more detailed reads like Maple Tree, Capital Land. What we try to do is to decipher and go through all of that. That's why you can see that my degree is very high, 1,400 on both sides, or rather on each side. Okay, so but it's something we enjoy, and we've been doing it for the last 32 years. So as you can see from the exercise, we rise above it, we look left and right, we look deep into it because you notice we have a convoluted, inverted way of looking in detail. As Charlie Munger, the right hand man of Warren Buffett, always tells you, okay, when you have a problem, always invert the problem, right? So, what actually is the cause of the problem? What are, and once you know your facts well, because we have been developed this habit of going through all the announcements of the real estate investment trust, be it acquisitions, you can see that essentially sometimes you can clearly, because you know your facts very well as well as the timing, you notice as a lot of times many of the things do not add up way before they do not add up, and this is something that we then forewarn in our investment classes as well as actually in our YouTube video. So be sure to subscribe to our YouTube video to be forewarned in advance. But of course, the best is to attend our investment classes because we explain the process, we explained the findings so that you will not be caught in a rut like what you have seen on Manulife REIT, where analysts only cut the share prices target by as much as 31% only after the share price has fallen, not before, which is something that we are able to do or have been able to do as our track record has shown. By the way, in the video, the two little cute little girls, they are my 2-year-old and 4-year-old. So you can see, ladies and gentlemen, when you exercise and sharpen your mental ability at the same time, you are actually having a great time with your children. So it's something, ladies and gentlemen, that you and I can do and continue to do so that that will help you to sharpen your mind. But Gabriel, in all financial literature as well as financial journals, publications, in the even in the CFA program that you teach, it's been asserted that market timing is something that is very difficult to do, and most fund managers don't even do it. They have always taught and say that timing in the market, is more important than getting the timing right. What are your views on this? See, my friends, our views and ability on managed investment, because it's actually a mental faculty of our financial well-being, is actually shaped by a lot of experiences that we have undergone through. So, if I may share something with you, this was in the Sunday Times almost 20 years ago. Yes, in my Sunday Times interview on 1st November 2009, where the headline was Fortune Favors the Bold Investor. Now, that article profiled me getting into and buying into the likes of AIG and Citigroup below $1. Of course, Citigroup now is $46, 20 years later, and you notice that the ability to be able to buy when there's literally blood on the streets runs deep in my blood, So it's something, therefore, ladies and gentlemen, that in my latest article that's in GCP Global website, yes, please take a look. It's free. It's archived there, as well as our last 31 years of research, where our latest article is Headwinds Are Shifting to Tailwinds for S-Reits. Okay. Right timing is a concept that a lot of market so-called experts and analysts in inverted commas have profit as very difficult and impossible. But really, ladies and gentlemen, you know, the definition is that if you want to earn outsized returns, no one is earning, then you have to do things that no one is doing, right? Or are easy to do. Guess what? And you have to do it within the right timing. So this is one aspect that has governed and shaped my investment philosophy, which I have been sharing and educating in my REITs investment classes. So the key thing, as I've mentioned in my earlier exercise, you notice that the ability to rise above the bar, see left and right, go through all the REITs analysis as well as their forecast, as well as their so-called propounding aspect of their presentation materials, presenting the best side of their acquisitions. We dig through this, we find a lot of inconsistencies over the years and continue to do so, and that's why we point it out to you. So having the right timing doesn't mean that you have to be right 100% of the time, but if you are about right most of the time, this could be a great, fantastic lever of maximizing your wealth. And that's henceforth today's article on the wealth paradox in REITs. So if you want to become wealthy in REITs, then you must get your timing right. Then again, it does not mean that you have to buy at the lowest all the time, but having a semblance, having the knowledge, having the courage, having the ability to know that you are close to the bottom and avoiding those stocks like Manulife, Primary, at the top when you know that a lot of things do not add up. And it was very clear in the presentation materials, that they actually dish out every quarterly in the earnings results. All you need to do is to track what they say, what they have produced, and whether they have measured up. If they don't, then it has been a warning siren much, much earlier. So remember, I'm no God, but when I wrote Making Your Millions in REITs, I was able to foretell that Manulife REIT will collapse by more than 50%, and it did, in the course of this period in time. So it is due to certain ability, certain concept that we hold here, that is, a REIT is as good as the assets that they owned. So if the REIT does not acquire assets that add up to the earnings ability, then you know that the share price is not going to perform. It may outperform in the short term because the stock market is a voting machine, but it will not perform in the long term because it is a weighing machine. So once again, thank you for watching this week's video. Hope you enjoyed, and do read our website with a whole host of knowledge and become an ebullient, enthusiastic, and rich and wealthy investor that fortunately the Lord has blessed me with. Thank you so much once again, ladies and gentlemen.